So maybe we'll just start with there's a brief history of GP stakes. On our pre-call, we had about a 30-minute history, but they started about 1988, and about 20 years later, there was a fund that came out. So people just used to invest in the GPs. We had a session just for the family offices at our conference this year, and one of the families that this came up, and they said, "Well, shoot, we could make a lot more money investing in the GPs than being LPs in their funds. Like this is a great opportunity for families and for other investors." And you can liken it to being the hair club for men. If you like the product so much, maybe you should get into the GPs. So let's hear from start with you, Mike. We'll hear about GP stakes and kind of what's the motivation of both sides that you've seen, both from the investor side, the LPs and the GPs, and then the GPs, because I think that's changed over the years as well.
Sure. I think why the asset class has gained appeal amongst institutions, high net worth individuals, is that it offers a very, very unique risk return skew. Essentially, when you're buying into a GP, it's a great business, by the way. You're buying into a business that has high recurring revenue that's contracted, not unlike infrastructure assets. But unlike infrastructure assets, there's no debt on these business. So effectively, what it's allowing you to do is buy into a security that has bond-like downside protection, bond-like yield, but still gives you the opportunity to make private equity upside returns. Now, from a GP point of view, GPs are doing this. I think there was a lot of misconception about the space in the early days. People thought, oh, if a GP is selling a stake, they're becoming misaligned to the business. But what you've seen is actually it's a way to further align them to the business. Because if I come in and I buy a forward strip of their cash flows, which are management fees, essentially with a GP, if they want to maximize their management fees, they want to maximize their growth, not necessarily their performance. But if I buy that forward strip of management fees and then they invest that into their GP commitment, they're shifting the alignment away from asset growth and they're shifting it to performance. So GPs will typically do this to, one, increase their GP commitments to unlock further growth of their business. You'll also see a GP do this as essentially a way to create more stability for the firm. Sometimes it's to seed a new product. But essentially the idea here, and then other times it's to basically create a succession plan. Because at the end of the day, these are human capital intensive businesses, and the assets of the firm are the brains that are in the room. And you need to find a way to essentially align the junior talent or the junior partners to the firm. So doing a GP stake deal allows you to do it. But those are the main motivations. And sorry if I stole.
Yeah, I was just saying, sorry about that, buddy.
But as the LP.
Maybe also you can expound upon what the GP gets in the way of marketing, because obviously if an LP is in there, they're going to tell their friends to invest. But what's your view on that as well?
Well, just to add to that, I think there are a couple of factors that make it an attractive asset class from an LP perspective. One, given that the growth in alternatives is an asset class, most LPs do have the tendency not to diversify or sprinkle capital across multiple GPs. So if you get into the dynamic of re-upping significantly with every LPs, that you're anyway a natural partner to these GPs. So you might as well consider the attractiveness, because it's a proven asset class with time. And the attractive part is if you compare managers that are listed, the GPs or the ones that are in the alternative space do trade at a higher valuation. That's another factor that makes GP stakes versus owning an asset manager that has a larger scale of AUMs that are not sticky. Because remember, on the GP side, most of these assets are long-term, where there's an alignment of interests and a performance fee and carry pool. So the growth in the asset class of alternatives in general makes these GPs an attractive value proposition. And to add to that, before there was always a concern that made us as an LP hesitant to pull the trigger on GP stakes, which was the exit, because there wasn't a massive, large market. But because, again, of the growth in the assets in the alternative space, you started seeing even liquid managers, and it's public news that, for example, BlackRock acquired GIP in the infrastructure space. So that makes these larger managers even more as a conduit for an exit down the line, which makes the asset class promising, because once you have sustainable capital that is existent and investable in the asset class, larger asset managers in the room for consolidation, that makes GP stakes, at least for us as an LP, as an interesting dynamic to look at.
I guess at some point there's fund of GP stake funds, and then secondaries of GP stakes, and everything kind of flows through that. How about like maybe explain the stages, because obviously there's emerging managers, those with maybe $500 million or so, and there's some that specialize in the much larger ones, and they want to take it from 5 or 10 billion to 50 or more. What do you guys think of those two? Is it like starter homes and luxury homes, or is there any sort of analogy that people can use?
Yeah, I mean, how I think about the universe of GP stakes is, and I think you were alluding to one, which I don't generally consider a GP stake, which would be seeding, which would be the startup manager, which you give LP capital to in return for a share of their firm. But I don't really look at that as a GP stake per se, because it doesn't have the same drivers of return. It's mostly being driven by the LP performance of that initial seed investment. But how I actually think of the GP stakes universe is you have large cap GP stakes, which are 10 billion and above. You have mid cap GP stakes, which are firms that have assets under management of 3 billion to 10 billion. And then you have lower mid market GP stakes, which are called anywhere from like 300 million to $3 billion of assets under management. And I think, how I think about it is when you look at the large cap GP stake world, it's a little bit of a different animal than the lower mid-market world. When you look at the deals that are happening there, typically a lot of the proceeds or the uses of the proceeds is secondary, where the GP is actually taking money out of the business and using it to diversify their wealth. Whereas if you get to the earlier stage managers, called like the lower mid-market managers, there tends to be a greater skew to doing primary proceeds, which is the money staying on the balance sheet to essentially catalyze growth and further align the manager to the growth of the business. So that's how I kind of think about the universe, is chopping it up into those three main segments.
Yeah, I think that's a very relevant thing, and it goes also. What I would add is that it goes hand in hand with why we believe GP stakes and asset class is here to stay. Is you started having that segmentation of GP stakes managers, the ones that focus on the larger buyout or mega cap funds, and then you have the larger alternative managers that are anyway now, after reaching a certain level of vintage size, they can only grow really by being acquisitive where the pools of talent, and I refer to the earlier example that I just mentioned, where BlackRock all of a sudden now wants to do infrastructure. So instead of building and ramping up their own team, they would buy an infrastructure manager, for example. When you look at that asset class from that point of view, I think I agree with Michael's comment that not only we look at it from mid-market or size, where the size is anywhere between 300 in terms of vintage size, all the way to that 3 billion. That population of managers is large enough, performing enough, and significant enough now to do a GP stake strategy focused on that. And it's also a way for these managers to compete on talent. Like most of the interesting motivation that they've showed recently is the ability to kind of monetize a bit of their carry pool, to bring on additional partners, or grow up the team, or focus on carve-outs of their strategy, which is a testament as to how the asset class has matured and developed. We've also seen recently GP stakes that are larger in scale and focused on the larger side, now having a carve-out for mid-market or for niche first vintage managers for pivots. So, which is an additional attractiveness as to why focusing on GP stakes and focusing on the mid-market space is quite interesting. And to a testament maybe to Michael and his team and whatever they're doing in the space, the asset class, when it's focused on the mid-market, at least based on the work we've done, it's showing a very interesting characteristic, which is it combines benefits of the private credit side and the the private equity side, where you get to have that upside once the manager scales from the mid-market size and they have delivered on that growth of assets. And if they don't, you still have the hedge that if they continue being disciplined on their core vintages, vintage size, and their strategy, which is what we want them to do as an LP. They deliver that private credit return just by passing through management fees and carry. If they just focus on same vintage, deliver on exits, and then pass through the realizations as a shareholder alongside the investors.
And then maybe we'll just touch on structures quickly. So is there typically just equity that they're getting, or is there lending involved? Because obviously they need capital for various reasons. And then has there been like an evolution in that since over the last 30 or 40 years?
Yeah, so I would say when you look at the large cap GP stake space, almost every single deal is an equity-only deal. Mm-hmm. What you've seen, call it in the last 4 years, is you've seen specialty GP lenders come in, where they'll come in side by side with the GP stake buyer.
Sponsored stuff, yeah.
But the debt is not being issued to me as the GP stake buyer. It's actually being issued to the GP.
Right.
It's lending against their cash flows that I don't own. So sometimes they do that to come up with capital. But I think what's interesting about the lower mid market is that additionally, they're doing equity deals, or we're doing equity deals, but there tends to be more degrees of freedom in terms of deal structure. So oftentimes what you'll see is we'll do things like convertible preferred securities, which help protect the downside for us and help sort of achieve the risk return skew that we're looking for. So I think that's a unique characteristic. Once again, it's something I mentioned before, but typically in the large cap deals, what you're seeing is there's some meaningful portion of the proceeds that are secondary proceeds, which the manager is typically cashing out of the business. Whereas when you're at the lower mid-market or the mid-market, the skew is definitely more toward primary proceeds, which is those dollars are staying on the balance sheet to catalyze some sort of growth.
How about effect on the compensation plan of the employees? Because now they've got someone else that's owning part of the GP. Does that affect their options and their equity holdings, and how does that play into it? Is it a positive thing for the employees, or is it like,
Absolutely.
Oh my God, now we're PE of a PE?
No, it's a very positive thing, because as I said in the beginning, I think when the strategy first sort of started taking shape in a fund format in 2007, the criticisms that I heard were the managers cashing out, they're misaligned. That's the sign to bail out and not invest with the GP anymore when they sell a stake. But I think that with the passage of time, what research has shown by PitchBook and Preqin is that firms that have actually sold the GP stake have outperformed the broader private equity indices. So, i.e., they've outperformed firms that have not sold the GP stake. And the other interesting finding has been is that there hasn't been a degradation in return after doing the GP stake deal. And I think a lot of people will ask, well, why is that? And I think the reason is that essentially when you're doing a deal like this, one, you're increasing alignment of the GP to the firm. As I said at the beginning, when you're buying, a forward strip of management fees, and management fees are more aligned to firm growth than performance, and I'm actually buying that, and the GP is then putting that money into their GP commitment. By definition, I'm further aligning him to performance and taking away some of the alignment to asset growth. But I think more importantly is that it engenders a more stable firm, because you're creating a more long-term durable firm. Because at the end of the day, these are people businesses. And if you don't equitize the junior partners and give them some sort of equity plan, eventually what they're going to do, if they're truly talented, is they're going to start their own GP, their own private equity firm, or they're going to get poached and go work for one of the bulge bracket firms like Blackstone or Carlyle or KKR. But what you're essentially doing is you're placing a valuation on the firm, and you're creating a mechanism for these junior partners to buy in. And by locking them in, through succession plan and retention planning, you're making the firm more stable, because these people will be less inclined to leave the firm in the future.
Oh, yeah. I like how you had PitchBook and Preqin are two sponsors. That's good. And then, I mean, for your multifamily office, how do your clients view this? Do they see this as a big opportunity or something that they're still looking at, or what's kind of the evolution there?
I think when we started introducing the concept 5 years ago, that was kind of it created big question marks on misalignment of interests. The first question, I mean, I'm sure Michael, you had the same experience when you're talking to independent LPs. the same questions align, like why is a key person in a manager selling a stake? But I think when we are being a seasoned LP on the other side, we're always negotiating key man risk. And we realized with time that GP stakes are a perfect way to hedge these key man risks down the line. Because as long as you're focused on the mid-market, and these are minority deals, they're not majority, and they're never, most of the time, a full exit. You have detailed term sheets now that detail the use of proceeds to bring in new talents, monetize GP carry. That makes them more comfortable with respect to the asset class. What we've also realized is that as long as the asset class is now established, you have managers focused on the larger bracket side, the mid-market side, and to your earlier point, focused on different ways to finance these GPs, from the debt side to the equity side, but it's most of that is primary capital. But we certainly look at managers to make our LPs more comfortable, that it comes with a lot of strings attached if it's secondary capital, and that's the nature and the quality of the GP manager in the GP stake space. One thing that I think shaves off or kind of makes most of our families more comfortable with the asset class is the earlier point that I mentioned, that it's starting to have a clear characteristics. There is a hybrid between private credit and private equity. Once they see that the returns are there, if you're focused on the GP stake side, but with better DPI than looking at buyouts, because you're dependent on markets and exits, because you started clipping the earlier cash on cash yields coming from the management fees. I think that kind of swings the pendulum for most skeptics on the asset class in general. The other and last kind of pushback that we've always had is, how do we exit, excuse the language, that stuff in the end, because you don't want to be stuck in a manager where you're just clipping coupons. But certainly when you look at the growth in alternatives in general, the M&A activity that is happening, consolidation among larger managers, and other than creating growth by raising yet another bigger fund and larger fund, one of the ways for them to consolidate is to acquire smaller managers or separate asset class windows within the alternatives. And that's the activity that we've seen an uptick in, and this is why GP stakes are is kind of, so that resolves the exit kind of question mark and risk. And this is the key questions that once we go over all of these risks, the level of comfort is definitely better.
Yeah, it's like a fund of niche expertise. They don't have to be these huge asset gathering machines in one simple strategy. So well, maybe we'll stick with you for the results. So you've seen quite a few GPs, then we'll go specifically to Azimut's returns. But so what are you seeing for returns? And then, or how long, has it been long enough for the investors to see maturations and realizations from their funds?
I think it has been long enough. I think the first GP stakes transactions have existed for many years, as long as we can remember. But now there's definitely evidence that as the asset class has grown, and by asset class I mean alternatives in general, both in terms of fundraise, dry powder, lack of exits, it's not only important, the same way with secondaries, to kind of have that growth from a GP-led secondaries, LP-led secondaries, to have that flexibility at the GP stakes. So returns have been there. I think when we benchmark GP stakes as an asset class, you're in excess of mid-teens all the way to 20+ returns with managers, as long as they execute within the mid-market strategies. These are the types of returns that we looked at. The interesting.
How long for the whole period?
Most of these, at least what we've seen, it's the track record has been, as I said, like existing since the 80s, with managers that have done the same mistakes in buyout that are now in the larger space. So you have GP stakes that are raising in the tens of billions as managers, and this is they surfed on the success. Now we've seen GP stakes managers that are focused on the mid-market, and these are where we see the returns are, driven by multiple ways and the flexibility that you have to kind of generate not only returns, but cash returns, DPIs in that sense. Because these managers, when they're at a smaller scale size and they deliver, you have to look at it also, we're not only focused on returns, because as a capital allocator, this is a strategic alignment for us, because mid-market managers in general tend to outperform, let alone if they're managed properly with the right governance, with the GP stakes who is in these managers and monitoring at a minority stake proper governance. So we use them as a conduit for an asset class, not only to allocate into these managers, but also to do direct and co-invest. It's easier to have that discussion when you're a GP, an LP in the GP stakes, owning an equity in the manager and having a direct co-investment. So it's not only a returns question for us. And it's certainly like when we're trying to allocate capital globally in the asset class, rather than having teams scouting managers in the mid-market space, and it's easier to do that under GP stakes window, because most of that work is done with buyers of that equity rather than an allocator.
Yeah, I think from my personal experience, deals that I've sourced and led through the years have produced a 26% IRR, a 2.7x multiple on invested capital that projects to finish around a 3.4x. So I've seen the returns firsthand. I think the other thing that I would highlight too, and this is expanding upon one thing that my other guest talked about here, is that when you're dealing with mid-market GP stakes, there's just more ways to exit. I think one of the criticisms of the large cap space is that where are you going to exit? Will there be a public market exit? Who's the next buyer? But the nice thing about when you go to the lower mid-market is when you have a lower mid-market manager that grows to become a mid-market manager, you can naturally sell it to the larger GP stake funds, be it the mid-market funds, the larger cap GP stakes funds. And in fact, at Azimut, we had a nice realization from a GP stake that we did about 4 years ago, where called Kennedy Lewis, where we actually sold it to Goldman Sachs Petersil at a 4x return and a 70% IRR. So we like having that natural exit to the larger GP stakes funds, but then also we can also sell to strategics, because when someone's looking to do a bolt-on strategy, call it in private credit, infrastructure, I think the preferred method of growth, as you were pointing out before, is to be acquisitive, acquire a manager that's a mid-market manager that you believe has the capacity to grow to become a large cap manager. So we've also pursued that angle in terms of exits as well.
Cool. Any questions from the audience? I'm going to get the big X from our moderator here, super moderator. Any questions? No? Okay, so what can sink SS GP stakes? What's the big problem that can come over the horizon to just make this possibly one of the worst investments for people?
I think
so. I rephrase it different from the pre-call just for this.
Yeah. So when I think about it, I mean, to echo Amin's comments before, is the asset class is here to stay, because one, private markets are growing. 90% of global revenue is from private companies. And if you look at public market AUM, it's over 200 trillion, whereas private market AUM is like 14 trillion. So we have tons of growth ahead of us. But what I would say is that, GPs are going to continue to need capital solutions, just like LPs need secondary funds to provide capital solutions, just like portfolio companies need private credit firms to provide capital solutions.
Seems like an arms race. All these GPs need more and more money to go against the other GPs.
Yeah, so it's here to stay. But when I look at myself in the mirror and say, what's honestly the biggest concern? I think it's a loosening of terms that we've seen, terms and protections.
Covey Light, yeah.
In GP stake deals, in legal documents, because we've seen, essentially there's been some less experienced buyers that have come into the space. And I think it's almost like summit fever, where just to get a deal done, they're willing to cave on some really critical points, be it restrictive covenants, be it the protection of your economics, be it your ability to sell the stake. Because early deals that we did at Wafra, for example, we could transfer that stake pretty early after the deal. But we were handed a term sheet not too long ago where the GP was basically mandating you're not allowed to sell the stake for 7-8 years after you do the deal. So things are drifting in a less positive direction. It's not fully there yet, and you can certainly push back and GPs will cave on it. But I just fear that you're going to have new entrants come in, and the documents are just going to be looser and weaker, and that's going to become what GPs and lawyers call market. and it just makes it less of an attractive asset class if that occurs.
So you're worried about the kids coming in, that's good. She's real. Yeah, I guess we're done. Okay, everybody, we're gonna go to drinks, and I think that's anything else to say? Thank you. See you at the canteen.